Welcome. In this video, we're going to look at job order costing and some of the key concepts associated with job order costing. Remember, our formal costing systems such as job order costing and process costing are dependent upon the underlying type of production technology. In other words, are we working with a job shop or are we working with a flow shop? If we're working with a job shop, then the appropriate costing system would be job order costing, which is what we'll talk about here in Chapter 4. If we're working with flow shop, the appropriate costing system would be process costing, which we will look at in Chapter 5. Now, this diagram right here is a very useful way of getting an overview of what's happening in our costing system. Up at the top in gray, we have our value chain. Our value chain depicts the various business processes. Notice that manufacturing is in the middle of our value chain, and our manufacturing business process breaks out into various manufacturing facilities. Those are illustrated in green: manufacturing plant 1, manufacturing plant 2. Each manufacturing facility is most likely going to have operating departments and support departments. Support department allocation, the allocation of support department cost is treated in the appendix to Chapter 4. We will not cover that in this course, so let's focus our attention now on the operating department. In our operating department, we have a cost measurement system in place. This is the first thing that you need to do in any problem that you work. Get a handle on what is the existing cost measurement system. What does that mean? That means what are the cost pools and what are the cost categories. In this case, we have two cost categories, one for direct material, one for direct labor, where we will accumulate direct costs, and we have one indirect cost pool, where we will accumulate our indirect costs. For every indirect cost pool we have, we need to allocate those costs. The way in which we do that is very straightforward. We calculate an allocation rate. In order to calculate that allocation rate, we have to ask two questions. Question number one: is this actual costing or is this normal costing? Which means what? If it's actual costing, it means we will use actual numbers to calculate our allocation rate. To calculate our allocation rate, what goes in the numerator is the cost we've accumulated, and what goes in the denominator is the cost allocation base that we're going to be using. If it's normal costing, we're going to use budgeted numbers for my numerator and my denominator. The second question I need to ask is, what is my cost allocation base? What am I going to use as a denominator in order to allocate the costs that I've accumulated? Traditionally, we've always used measures of production volume. They could be units of output, or they could be input measures of production volume, such as direct labor hours, direct labor cost, machine hours, etc. I refer to this as a volume-based costing system. A lot of textbooks will make a reference to a traditional costing system. Again, I find that confusing for students that are not familiar with this, so I try to use the most descriptive terms I can, and that would be a volume-based costing system. What does that mean? That means that we are using some measure of production volume as the cost allocation base in order to allocate our indirect manufacturing costs. So to illustrate this, let's just assume that the costs that we've accumulated in our operating department, our budgeted indirect costs are $100,000. We're going to use normal costing. Let's assume we select a cost allocation base of direct labor hours, and budgeted direct labor hours are 10,000 hours. So our normal manufacturing overhead rate would be $100,000 divided by 10,000 hours, or $10 per direct labor hour. Then we would allocate those costs to the job orders based on how many actual direct labor hours a job order used. For example, if job order A used 100 direct labor hours, that would be 100 times 10, or $1,000 of allocated indirect manufacturing overhead cost to that job order. If job order B used only 50 direct labor hours, then it would be 50 direct labor hours times our normal manufacturing overhead rate of 10, for a total of $500 allocated to that job order. So the mechanics of how we allocate the costs are very simple and very straightforward. Now, something that we need to start doing immediately is, for any given event that happens related to manufacturing, the acquisition of material, the requisition of material, the use of labor, the use of indirect labor, the incurrence of other types of manufacturing overhead costs, finishing products, so forth and so on, all the different kinds of economic activity that would happen within our manufacturing process. We need to always be thinking about this in terms of three things. Number one, what is happening operationally? Number two, how is that going to be handled by my costing system? And that's going to, of course, depend on how my cost, what my costing system looks like. For example, in the illustration on the previous slide, we had a costing system with two direct cost pools and one indirect cost pool. That means that all of our direct material will be accumulated in that direct cost pool for direct materials. All of our direct labor costs will be accumulated in that cost category for direct labor, and all of our indirect manufacturing overhead costs will be accumulated in that one cost pool. So once again, three things we have to be aware of for every event. One, what actually happened operationally. Number two, how is our costing system going to handle that? And three, how is our general ledger financial reporting system going to handle that? In other words, how are we going to journalize that and get that into our formal accounting system? So let's take a look over here. This diagram right here shows the cost flows through our general ledger accounts, through our general ledger manufacturing accounts. This is very similar to the flow chart that we looked at back in Chapter 2 for cost of goods manufactured. So I would suggest you go back and take a look at that flow chart. So let's take a look at our raw material account. So in raw materials, what happens? Imagine we have a raw material warehouse. Well, what happens? We go and we buy raw materials and we have it delivered there. All right. For material that we have in that warehouse, what can happen to it? Only one of two things. Either we use it or we don't. If we don't use it, it stays in there and it becomes my ending inventory for raw materials or for direct materials. If we use it directly in production, then it gets moved over into our manufacturing area where we're actually working on the product. That's what happens operationally. We requisition those materials. In terms of our costing system, what do? We will trace the amount of materials to a given job order as that job order utilizes those materials. And in terms of our general ledger system, what's going to happen? We are going to transfer the dollar amount of those materials that were requisitioned. We're going to transfer them out of our direct material inventory account into our work in process inventory account. Now let's take a look at labor. Labor can't be inventoried like inventory can. We use it when we pay for it. We can't buy it now and use it later. So we don't have the same process that we do for direct materials. But when I incur my direct labor cost, what do? That cost will be traced to the given job orders that utilize that direct labor. In terms of my general ledger financial reporting system, what will happen? I will again debit work in process and credit wages and salary payable for the amount of labor that's been used. Now let's take a look at our manufacturing overhead account. Our manufacturing overhead account is a temporary account, which means that it has a zero balance at the beginning of the period. And if it has any balance at the end of the period, that balance needs to be closed out so that it has a beginning balance at the beginning of the next period. In our manufacturing overhead account, when we actually incur manufacturing overhead costs, we debit that account. So for example, we receive a utility bill for our manufacturing facility. What do we do with that cost? We take that cost, we accumulate that cost into our manufacturing overhead cost pool, and in terms of our general ledger financial reporting system, we're going to debit manufacturing overhead and credit cash, for example, when we pay that bill. So our manufacturing overhead account is going to accumulate debits, and those are going to refer to actual manufacturing overhead costs incurred. Then when we allocate the cost, and we saw previously how we would allocate that, we would calculate an allocation rate. That would be a normal rate or an actual rate. That also implies that we selected our cost allocation base, and then we would multiply that rate times the actual quantity of the cost allocation base used by the job order. We're going to credit our manufacturing overhead account and debit our work in process account. In other words, we're going to transfer those costs out of manufacturing overhead into work in progress. So our work in process inventory account is a master account. All of our job orders are subsidiary records of our work in process inventory account. In other words, if you took all your job orders and added them up together, they would balance out to what the balance is in your work in process account. Now, what happens in that account, or what happens to my work in process inventory? Operationally, those are units that we've started but not finished. So what can happen to them? Only one of two things. Either I finish them or I don't. If I don't finish them, they stay in work in process as ending inventory. If I do finish them, they're what we have calculated previously as cost of goods manufactured, and they're transferred out of work in process inventory into finished goods inventory. With finished goods inventory, what can happen to the units that are in there? Those are products that are completely finished, they're available for sale, and only one of two things can happen to them. Either they get sold or they don't. If they do get sold, they get taken out of finished goods inventory. Customer takes them away. That's what happens operationally. In terms of our general ledger financial reporting system, we're going to debit cost of goods sold, which will go onto the income statement, and we're going to credit our finished goods inventory for the amount for the cost of those units that were sold. Now, when we calculate our manufacturing overhead rates, our indirect manufacturing overhead rates, which we will do for each cost pool that we have to answer those two questions. Are we going to use actual costing, normal costing, and what cost allocation base are we going to use? Well, if we decide to use normal costing, that means we're going to use budgeted numbers. So what goes in the numerator of that rate is the cost that I've accumulated. So I would use that budgeted cost. And what goes in the denominator, let's assume it's some measure of production volume, such as direct labor hours. That's going to be budgeted direct labor hours. Well, where do I get that number from? That number is some reflection of manufacturing capacity. And so we have these various manufacturing capacity concepts. Actual capacity, theoretical capacity, practical capacity, normal usage, average usage, budget or expected, so forth and so on. So while we may not always be able to answer this question, we can always ask it. What measure of capacity is being utilized when we use normal costing in a given scenario? And we can broadly think of this in terms of the supply of capacity and the demand for capacity. The supply of capacity is illustrated on the left-hand side of this diagram. We have a theoretical capacity, and then we have a practical capacity, which is something less than our theoretical capacity. Then on the right-hand side, we have our various different demands on that capacity. It could be actual demand, it could be expected demand, budgeted demand, so forth and so on. This is an extremely important concept because right now what we're focusing on is properly costing or capturing resource consumption, properly costing our products. But ultimately, we want to be interested in cost management. Well, cost management means resource management. And resource management means using resources efficiently and effectively. So let's define those terms because they're absolutely critical to what we're doing here. By efficiency, what do we mean? Efficiency is a relationship between input and output. If I'm more efficient, I can create more output with the same level of input, or I can create the same level of output with less input. Efficiency is something we always want to be interested in if we're focusing on variable resources. Variable resources are divisible resources. Effectiveness. What does effectiveness mean? Effectiveness means meeting your objective. Well, if we're talking about indivisible resources, what we refer to as fixed costs, it doesn't matter if we become more efficient. That's not going to change those costs. So what we want to do is we want to make sure that we're always effective in utilizing that capacity that we've purchased. The example I always use for this is the airline industry. If you look at the cost structure of the airline industry, the vast majority of their costs are fixed. which means no matter how efficient they are, there's not a whole lot they can do to change their costs. So what becomes the name of the game? The name of the game means filling up your airplanes and making sure your airplanes are flying as much as possible. So anytime that we're focusing on fixed costs, and we'll get into this later in the course, but anytime that we're working with fixed costs, we always want to get a handle on how effectively we are utilizing those fixed costs. Whenever you think of fixed costs, think of capacity, because that's what fixed costs are. You're purchasing capacity. When we're working with variable costs, we always want to be thinking in terms of efficiency. And can I find a better way to do what I'm doing so that I use less input in order to generate more output? So I'll give you a simple little example here to illustrate these. Let's assume that we were going to analyze the use of a classroom up at CSU Pueblo. And let's assume that all classes ran for 1.5 hours. And we go off and we purchase a classroom. And we're purchasing a degree of capacity. The cost that we're going to incur is fixed. No matter what we end up doing, that cost isn't going to change. All right, so what's the amount of capacity that we purchased? What's the theoretical amount of capacity? If each class would be 1.5 hours, then how many classes could we teach in a 24-hour period? We could teach 18. And let's assume that we're going to define our capacity, our annual capacity. So if we could hold 18 classes a day, and there's 52 weeks in a year, then how many classes, how would we express our theoretical annual capacity for that classroom? It would be how many classes? It would be 936. Okay, now, undoubtedly we cannot run classes 24 hours a day, so let's be a little bit more realistic. Let's assume that we can run classes from 8 in the morning until 8 at night. In other words, we can only practically operate over a 12-hour window instead of a 24-hour window. If that's the case, then how many classes could we offer in one day? That would drop down to 9. Okay. Now let's talk about weeks. Previously, we assumed that we were operating 7 days a week. It's a more realistic assumption that we would only operate 5 days a week. And finally, weeks of the year. Before we assumed we were operating all 52 weeks. Now let's assume that we're only operating, let's say 40 of those weeks. That would give us our various holidays, so forth and so on. So now what would be our practical capacity? Okay, I made a mistake when I calculated our theoretical capacity, so let's do that again. Got 18 classes per day, 7 days a week, 52 weeks out of the year. That would be a total of 6,552 classes. That's my theoretical capacity. That's what I paid for. My practical capacity is only 9 classes per day, 5 days a week, and 40 weeks out of the year for a total of 1,800 classes. So that's an illustration of the idea of capacity supply, theoretical or practical. Now we can look at capacity, the demand for that capacity. Well, what's the actual usage? Even though we might be able to hold 9 classes in a given day, there might only be demand for 5 or 6 or 4 or whatever. Okay, those are the various demands for capacity. We could have our budgeted demand for capacity based on what we expected for the upcoming semester. We could have our normal capacity. That's what some kind of historical average over a period of time. But to summarize, we have concepts of supply of capacity and demand for capacity. And it's very, very important because we will use these in the calculation of our normal rates, that we understand what type of capacity that we're working with. Okay, to finish up, there's just a few other little points I want to make. So let's go back here and take a look at this manufacturing overhead account. As we said, when we actually incur manufacturing overhead costs, we will debit our manufacturing overhead account, and we will accumulate those costs in a cost pool. When we allocate those costs, we will credit that account, and transfer the amount that's credited over into work in process. So what happens if we're working with an actual costing system? That means that our allocation rate that we use to allocate those manufacturing costs to production is based on actual numbers. If we use actual costing, we'll never end up with any type of balance or variance in this account. However, if we use normal costing, it's highly likely that we may end up with some residual balance. If it's a debit balance, we call that underapplied or underallocated overhead costs. If it's credit balance, overapplied or overallocated overhead costs. What do we do with these over or underallocated amounts? We should prorate them to work in process, finished goods, and cost of goods sold, but as a practical matter, we'll just close them all out into cost of goods sold. So make sure that you understand the implication of underallocated or overallocated manufacturing overhead. So for example, let's assume that we have underallocated manufacturing overhead costs in our manufacturing overhead account. Does that mean that we overcosted or undercosted production with respect to manufacturing overhead? It means that we undercosted. Why? Because the amount that we allocated to production was less than the amount that we actually incurred. By the same token, if we have overapplied, that means that we overcosted our product with respect to what our actual costs were. Why? Because our allocation rate, the amount that we allocated using our allocation rate, was greater than the amount of actual costs that we incurred. All right, finally, let's take a look back on this page right here. And I want to comment on the various problems with, or not problems, but the various issues, probably the most important issue that comes up with this. In a previous video, I had a diagram that showed the sweet spot in your costing system, the one that took into consideration the two predominant types of costs that are related to your costing system, the cost of errors and the cost of actually running your system. So what happens if we have a very simple system, as we do in this case? We have a very simple costing system in this case, in the sense that we have only two direct cost categories, that's normal, and only one indirect cost pool. Now here's the problem. Let's assume that the indirect manufacturing resources that we have are broadly capital intensive and labor intensive. And let's just assume that they're roughly half of them are capital intensive and the other half are labor intensive. But we only have one cost pool. Because we only have one cost pool, we can only calculate one rate. And because we're only going to calculate one rate, we can only select one cost allocation base. Now, if I have capital intensive resources, what's the most logical cost allocation base for capital intensive resources? That would be something like machine hours. If I have labor intensive resources, what's the most logical cost allocation base? That would be something like direct labor hours. However, I can only use one of them. So if I use, for example, machine hours to allocate all of the costs that are accumulated in this one cost pool, there will be a good causal relationship between machine hours and those capitally intensive resources, but there will not be a good causal relationship between those machine hours and the labor-intensive resources. By the same token, if I use direct labor hours instead of machine hours, I have the same problem in reverse. There will be a high causal relationship between the labor-intensive resources and direct labor hours, but there will be no real kind of causal relationship between capital-intensive resources and direct labor hours. Now, if all my products were identical, this wouldn't be a problem. But the fact is, in a job shop, my products are very dissimilar, and they make different demands on my manufacturing resources. I may have a job order that is highly labor intensive. I may have a job order that's highly capital intensive. So you start to see the problem here, where we end up, because we have a very simple costing system, we end up miscosting our products, or what we often refer to as cross-subsidization. How do we solve this problem? We solve this problem by improving the sophistication or refining our costing system. And in the example I just gave, the very best way to do that would be to have two cost pools instead of one. One cost pool for capital-intensive resources and one cost pool for labor-intensive resources. And then for the capital-intensive resources, when we calculated our allocation rate, we would use the appropriate cost allocation base, the cost driver, which would be machine hours. And when we calculated the allocation rate for the labor-intensive cost pool, we would use the appropriate cost allocation base, which should be the cost driver, which would be something like direct labor hours or direct labor cost. And we'll end up with far less distortion in our numbers. So we can conclude that with respect to our allocation, what makes a good allocation rate? Well, with respect to the numerator, we want those cost pools to be as homogeneous as possible. When we start to get a lot of heterogeneity in those cost pools, that's going to create a lot of distortion in our allocation rate. So in terms of the numerator, we want those the costs accumulated, the resources in a cost pool to be as homogeneous as possible. Secondly, with respect to the denominator, we want to make sure we use the correct cost allocation base, which should be the cost driver, the thing that causes us to incur the consumption of the cost that we're trying to allocate. Okay, that's it.